I think one of the big challenges in today's market is personnel and finding and retaining good talent. And when you purchase a business, you're not just purchasing that revenue and profits, you're also getting the employees associated with that business. And oftentimes in our deals, we see a very high percentage of employee retention.
Welcome to The Boost, a podcast for home service contractors. We explore leaders and innovators in home services, their personal journeys, thoughts, and experiences with growth, marketing, and succession. We cover the good, the bad, the ugly, and its ultimate impact. Hello, everybody. Thanks for being here. Welcome to another episode of The Boost. I'm Zach Wilson, Chief Marketing Officer of Local. Today, we have Dillon Caraway, Loan Officer at Live Oak Bank. Welcome, Mr. Caraway. Thank you for being here.
Yeah, I appreciate it, Zach. Happy and excited to join today.
Yeah, me too. You're the first of your kind on the podcast as we continue to explore the transaction space of home services. This is a good voice and expert opinion to have and help educate us all. Start off for those people that aren't that versed in lending in general. What's your role specifically as loan officer, and how do you help and sort of aid people in contractors, specifically in transactions?
Yeah, great question. So I work with existing owner operators and folks looking to enter the space with various needs in the HVAC, plumbing, and electrical industry. And I kind of separate it into two different buckets. We do a lot of growth financing for existing owner operators, and we do a lot of transition financing for folks that maybe want to exit the business. And then we have folks that want to purchase their first business. So I'll kick it off with the growth side of the equation. And with that, we do a lot of expansion financing. So say, for example, you're a heat and air operator or a plumbing business operator, and you really want to expand your geographic territory, and there's a company 45 minutes across town that they'd love to purchase and don't necessarily have the cash to do so. And the seller of that business doesn't necessarily want to finance it out of pocket with a handshake agreement. We help bridge that gap of providing the funding for that. And we do a budget review analysis, look at business plans for that transaction, and making sure that it's a sound decision on the bank's end, but more importantly, a sound decision on our customers' end, because we want to make sure that we're setting up customers for success. We understand that there's real people on the other side of these transactions, and we want to make sure that we're putting them in a good place to grow the business and succeed. So that's kind of what, an acquisition product could look like, or growth through acquisition. We also focus on commercial real estate purchases. So if you're an owner operator that, may be leasing your building, or you maybe own your own space, but, you've grown from 1 million in sales to 5 million in sales. You've grown your, employee count. You need more room to house inventory equipment. You'd like to have a room built specifically for training, and there's a nice piece of real estate across town, or maybe even land that you would like to purchase and, do ground up construction. We offer a great product through the SBA 7A program for those types of loans. And likewise, that's the same product we use for expansion through acquisition financing as well. But a really competitive commercial real estate product. Another way we help existing owner operators grow is through our working capital product. So if they want to grow organically, I think we all know that growing and scaling a business takes a lot of investment. And the HVAC industry, it can be somewhat of a seasonal industry, definitely depending on where you're located in the country. A lot of business owners may have a decent or healthy cash balance. They might not want to use that to invest in marketing, advertising, inventory, rewrapping trucks, redesigning their website. So we have another great product for that. And then we can also help refinance debt in certain situations, which can help improve cash flow and allow for additional reinvestment back into the business. So that's kind of the products we have on the growth side of the equation. On the transition side of the equation, we work with a lot of business owners that are looking to exit in the next 1 to 5 years. They have a key employee, or maybe a child in the business, a son, daughter, or family member, or maybe even another local competitor that would like to buy them out. And the big question is, how do I get paid in full and still transition the business to my son, daughter, GM, or key employee that might not have millions of dollars to pay me outright. And they went to their local bank, and their local bank doesn't understand what an HVAC contractor is and the value of that business. I think where we provide a ton of value on the transition side. So we kind of call it succession planning, and we do a lot of education with existing owner operators. And also we have a lot of conversations that may not materialize for 1 to 5 years with general managers or lead installers of businesses, and kind of help paint the picture on, hey, this is what the bank, whether it's us or another bank, could potentially look at in terms of getting the deal approved and helping you become the new owner of the business.
Yeah, that's interesting, especially on the succession side. That's really important. And then I think something also you touched on, which I think is interesting, is the fact that your local bank, as you pointed out, might not understand the businesses and the risks and how they work and how they're structured and how they make money, which can ultimately impact their willingness, if you will, to lend. Because as you said, there is part of the risk qualifier, I think, is a qualitative aspect, right? And just making sure that it makes sense to the lender. And you even said for Live Oak that you guys do review the proposals for some of those growth products. I don't know how diligently you review those, but you do put eyeballs on them to make sure that the economics of them make sense, right? Last week, I was listening to someone else's podcast, and I can't remember who it was, but they had mentioned you guys and using you and switching a local lender to you. Can't remember what the deal structure was they talked about. I was like, oh, I'm going to have Dillon on next week. How timely. So anyway, just digging into products a little bit. This is something that there's a lot of options out there, right? Of course, there's seller financing, which is basically cutting out all sort of third parties in terms of lending. You talked about SBA, conventional. What are other things that you find contractors, HVAC and plumbing specifically, engaging in from a product perspective to help them accomplish their goal or achieve their dreams?
Great question. So I would say the bulk of our business and the majority of the deals we work on are geared towards those two sides of the equation. We talked about growth and transition. It's hard to pinpoint one because at any given time, I'm working on 2 to 3 acquisition deals at a time. I'm working on 2 to 3 commercial real estate deals at a time. I'm working on capital deals all at the same time. So I think there's a huge need in the industry for these products. Unfortunately, the industry has been underserved by traditional or conventional lenders. I think you go to traditional lender or your local bank, they're more so concerned with their loan approvals based on loan to value, collateral, and equity injections. However, how we differ with Live Oak and through the SBA loan programs, we're able to base our loan approvals on cash flow. So the ability to service the debt associated with that loan, as well as pay the owner of the business a comfortable salary to support their lifestyle. So a long-winded answer there. I think acquisition's probably what folks come to us most often, acquisition and a working capital. Succession planning has gained a ton of traction over the last 2 years. Worked with a lot of different industry partners, providing education. If you're looking to exit, these are things that we would analyze if we're reviewing the business. So things you can kind of start preparing for. And these are things that your buyer will probably need to start being aware of. And it's funny, we'll have those conversations, and then 5 years later, hey, Dillon, we talked 5 years ago about me buying out my owner or me selling to my GM, and we're actually ready to make that happen. So I would say in present day, acquisition and working capital are really hot for us right now. Succession planning is something we're talking about every day, but when that may or may not materialize is dependent on the situation. And we always tell folks in those situations, you can never start planning early enough. So we encourage folks just to be educated and start those conversations as early as possible. And I think real estate will continue to increase for us. We've always historically done a really good job with commercial real estate financing, but with rates are where they are, some folks may be opting in to lease their building for another year if they're not, going to have a major increase and wait to see what this rate environment's going to do. We kind of hear different stuff in the news about increases or decreases in the Wall Street Journal prime rate, which is the rate we base everything off of. So
what are we at today? Do you check it every day? You got to check it at least weekly.
Well, it's different than like Treasury rate. I mean, Wall Street Journal prime rate is based off the federal funds rate, which is set by the Federal Reserve. So we know when that's going to change. The Fed, I think they meet like 11 or 12 times a year. don't hold me to that. I think that's a pretty accurate estimation. But yeah, I mean, if the Fed's going to adjust rates, we're aware of it. But right now, the Wall Street Journal prime rate is 8.5%.
FD.
A few years ago, it was like 3.5%.
Substantial. But just to speak to that, what's the impact you're seeing, if any, on transactions and moving deals forward?
I get that question a lot from a lot of different industry partners, from our coaching groups we work with, our manufacturers, our distributors. And oddly enough, we've closed the most we've ever closed up to July since we've been lending to the industry since 2019, and we have a healthy pipeline for the remainder of the year. So from a acquisition working capital standpoint and succession planning standpoint, it hasn't slowed us down a bit. We're actually ahead of where we have been in the last 5 years. I would say probably made folks scratch their head a little bit more about locking in or buying that piece of commercial real estate. Hopefully we'll have some rate cuts at the end of the year and we'll start to see that activity pick up.
Everybody hopes for that too.
Fingers crossed.
Yeah, exactly. We were talking about HVAC deals, and of course, none of that information of who that is can be shared, but we can, of course, talk really high level in terms of what their objective was, strategy in terms of getting the money, the why, right? What they were trying to do with it, some of the loan amounts, etc. So you want to just dive into one of those?
Yeah, we'll start off with the business acquisition case study. And this is a very common deal for us. The loan structure and requirements are going to be very consistent. Loan amounts and dollar amounts can change deal to deal, but from a general standpoint, the structure and terms are going to be very similar. We're working with a HVAC contractor that was running a nice business. They're probably running like $1.5 million top line revenue business. Been running that business for a few years, and they were looking to take that next step in growth and identified a business that was about 45 minutes away from them through their local network. And business was of similar size. They were doing about $1 million in revenue and $200K in EBITDA, or seller's discretionary earnings, or whatever you want to coin that is. We consider it just free cash flow. And the purchase price of that business was $600,000. And this is a super hot topic. I think a lot of people like to talk about in the industry is purchase price multiples. You've probably heard some crazy numbers thrown around in the last few years, talking about from like 2020 to end of 2023 with some of the larger transactions where they were able to get maybe 10x earnings of multiples. But this one was based at 3x multiple of net earnings, which is around our average for acquisitions in our portfolio. We've closed about 90 acquisitions since 2019, and the average, I think, through all of those is about like 3.6 times earnings. So about right in line.
I think something just to dive into, which, correct me if I'm wrong, as you ladder up in top line revenue or EBITDA, the value, it levels out, but it also increases your multiplier, right? If you're a 10 million top line revenue and 2 million in EBITDA, right? Those tend to, at least from what I've heard anecdotally, I haven't participated in any of those, but they tend to have higher multipliers as you go up in terms of revenue. There's more value in those types of businesses versus $1 million business, which some might argue might be a little bit more easier to spin up, if you will.
When you think of those $10 million companies that are probably doing $1 million, $2 million in net earnings, those companies have a really good management structure in place. The owner of that business typically isn't out in the field. They typically are utilizing, best in class field management software. They probably have great processes in place, and we would consider that essentially a turnkey ready business. But with these smaller companies, they're typically mom and pop companies that might still be paper based. The owner still might be out in the field. So it will require more investment into the business for it to grow and scale. Not saying that's a bad thing. Yeah, I think there's a lot of value in that. And, these business owners that are running those $1 million businesses have built fantastic businesses and reputations in the industry and their local areas. But it really just depends on what your appetite is and what your growth plan is. But getting back to this specific deal, $1 million in revenue, $200K in EBITDA or seller's discretionary earnings. The guy was purchasing it for $600K. And by using Live Oak Bank and the SBA 7A program, we were able to base the loan approval off the cash flow. As we both know, there's not a lot of tangible collateral in these businesses. You got trucks, equipment, and maybe some inventory, but not $1 million worth. And traditional banks, again, like to approve their loan decisions off collateral and loan to value. But for us, we can really utilize the historical cash flow of the business. And we were able to use that expansion SBA product, 7A product, and our customer was able to obtain a $650,000 loan without having to put any cash down by utilizing his existing business as a co-borrower on the loan. They received a 10-year term loan with a really competitive interest rate. This one closed when rates were a little bit lower. So this one was probably around 6.5% to 7% interest rate. If we're adjusting that to today's environment, that's probably going to be around 9.5% to 10%. But with that 10-year term loan, say they grow that business to $5 million in the next 2 to 3 years, increase earnings and maintain good profit margins, they can pay our loan off whenever they like without penalty. On SBA loans, there's only a prepayment penalty if it's over a 15-year term, which typically would involve real estate. So no prepayment penalty. And, really what the business owner got out of it was they were able to expand their service area. They purchased an existing customer base that was stable, reoccurring revenue. I think one of the big challenges in today's market is personnel and finding and retaining good talent. And when you purchase a business, you're not just purchasing that revenue and profits, you're also getting the employees associated with that business. And oftentimes in our deals, we see a very high percentage of employee retention. So all around great win for our customer. And they were able to increase revenue overnight by $1 million, increase earnings by $200K, and didn't have to use any cash off their balance sheet to do so.
Yeah, that's incredible. It's funny because I was talking to somebody yesterday that was going through this. They were not using SBA. They did a conventional plus seller finance. And it was really interesting too, because it was the same deal. Basically, someone retiring and the business was pretty good business, top line revenue. It was very similar to this actually. And same type of thing, like no back office, no technology stack, no sophistication, all paper records and owner in the field. And acquirer was acquiring from the acquiree a lot of personnel. This business, based on what he was telling me, what he was acquiring just from a personnel standpoint, it could not have been very profitable from their numbers. He had somewhere around this, and there was, I remember it was like maybe 7 people or something like that in the business. Like you said, a big challenge these days. Everybody is strapped for talent. Can you do more of this? Can you do more of that? And it's like, yeah, you can, but can you handle it? And a lot of people can't because they're having trouble finding good people and then the training that goes along with it. I think there was another one that we talked about that I thought it was interesting because it was just what you guys were providing for the lender in this case, and it was conventional, but it was a $30 million term loan, which I thought was really interesting because I hadn't really heard of this or thought, as you alluded, this is not a super common thing. But you want to just talk about that a little bit and what the use case, I think, is really the interesting part here of what you guys were doing and what you were providing, and then what the owner was using it for and how they were using it and why they were using it.
Yeah, 100%. So a lot of our products are geared towards the SBA 7A program, and that's typically what we start out with. In this specific case, we had a customer that got an SBA loan with us to buy a business, and then a few years passed, and they bought another business with an SBA loan, and then they ended up running like a $10 to $15 million company, and their goal was to get to 50 to 100 million in revenue. With SBA, you essentially have $5 million of runway you can obtain at any given time, and they had used their SBA runway. We wanted to still support them as their banking partner. The good thing with us is we have really great product that we can go conventional and go well above the SBA threshold of $5 million. So this guy wanted to acquire, let's just say, 6 companies in the next 12 to 18 months. From a conventional banking thought processes, we're really comfortable with this guy from a experience level, liquidity position, collateral position, and we're confident in his ability to tack on these businesses over this short amount of time and, them all be successful transitions based off what he's done in the past. We're able to approve a $30 million delayed draw term loan, which was essentially like a large credit facility where He has 18 months to make acquisitions out of that 30 million bucks. And each time he identifies a target, we do a quick underwrite and he would draw from that 30 million. So say his first acquisition was 5 million. We fund that acquisition. The 5 million goes to the seller. Our customer acquires that business. And then that $5 million turns into a term loan. And then he has 25 million bucks left in that credit facility, which is the delayed draw term loan. So the thought process is we want to be the banking partner to grow with you. We want to be the bank that's doing your first deal and that's doing your 10th deal. Like you said, unfortunately, not everybody's going to get approved for a $30 million conventional loan. But if the situation's right and we can get comfortable with the characteristics, we do have firepower at our bank to accommodate for that.
Yeah, which is amazing. How do you collateralize something like that?
So we'll take collateral if it's available, but typically going to be under collateralized in a traditional loan to value standpoint. So with conventional financing, they're typically shorter terms. So think 5 to 7 years to pay the loan back. There can be, different financial requirements and financial testing. And typically we do require down payments for those. Every situation is different. We've done conventional loans with no down payment. We've done conventional loans with 30% down payment. So it just depends.
Gotcha.
It's pretty cool that our bank can offer loans from $10,000 to contractors up to $30 million plus. We like to think that's pretty unique in the industry.
Can you just speak to some of the challenges that you as the lender find that contractors have in terms of getting these loans? You can probably speak to it on the SBA product side or the conventional product side.
To qualify for one of these loans, you have to fit a certain criteria. We typically like to work with businesses that focus on service repair and change out / retrofit, and typically have new construction exposure of 25% of total revenue or less. We like to see revenues at least 250,000 plus in top line. You have to be cash flow positive. How we get these things, primarily approved is the ability to repay the debt. And if the business is not generating a profit, then it won't be able to take on additional debt. So you have to be in a healthy cash flow position. Just a few of the main items that we look for in terms of business characteristics. And once a deal gets approved, what can cause hiccups or delays or even kill a deal? In the closing stage, I think it kind of boils down to two main things, in my opinion. One is time. Everybody has probably heard time can kill a deal. And that remains true with us. We typically see if deal drags on, that creates a lot of seller anxiety. We have seen sellers pull out if for some reason the deal is dragging along. Working with us or any other, what the SBA considers a preferred lender, they have the ability to move quicker than a lot of other traditional SBA banks that might have to go the general processing route. That can provide a little context there. But the SBA gives certain designations for lenders that are good stewards of the program that have performed well historically, a preferred lender status. And that just gives those banks, including Live Oak, the ability to approve and disperse funds in-house versus if you go the general processing route where you collect an application, submit it to the SBA, and then wait for the SBA to respond back, and then you enter the closing process. So I think it speeds up the process, by 90 days, give or take. General acquisition for us is probably going to be 6 to 8 weeks start to finish. And hear horror stories of some other situations where an SBA loan might have taken 6 to 8 months to close. And there's many different factors that can cause a deal to prolong. Could be completely out of the lender, buyer, seller, and SBA's hands. Not here to point fingers at anyone, but I think time can kill a deal. And then we see a lot of deals fall out with buyers and sellers not agreeing on purchase agreements. Typically, at least in my stage when I'm working with the customer, they're under LOI or letter of intent. And as we go through the underwriting process, they get formally approved. We get them pushed into closing. And then that's when they start to work with a legal counsel on their end, or maybe if they got legal counsel in-house, and they'll just draft their own purchase agreement. Typically, that will bounce back and forth between buyer and seller's legal counsel a few different times. And for some reason, maybe they can't agree on purchase price, or maybe there's a seller note tied to transition performance, which we've seen in the past. And then buyer and seller negotiations falling through on purchase agreements can definitely kill a deal as well.
Yeah, it's an easy one, right?
Yeah. Outside of that, we've been closing deals in this industry since 2019. We kind of know what to look out for, what hurdles are going to be there. And if there is a hurdle or an obstacle, typically we probably ran into it before and know how to overcome it.
Speaking to the hurdles, what's one of the hardest ones to overcome?
Buyer and seller not agreeing. For us, we don't get involved in negotiations for obvious reasons. We work with buyers on amounts we can finance, but we're not there to say, hey, buyer, this is what you should come back to the seller with in terms of an updated figure, or we're never telling sellers, this is what you should do to get the buyer to agree. There's a lot of lender liability laws. We stay far removed from that and really just work with the buyer on what we can finance. But yeah, if buyers and sellers can't agree on a deal, then it's just not meant to be, and we move along to the next one.
Outside of that control element of them not agreeing, what would be second? Because like you said, you're not going to intervene in a buyer-seller disagreement.
Yeah. And I
Yeah.
wouldn't say that this is like something that's common for us. It's something that's really important for us. I'm sure, if you've participated in one of these transactions, you probably have scratched your head or gone through the same process I'm about to discuss. But a lot of business owners will write personal expenses off through the business. If you have a guy that wants to sell their business and they've been taking vacations to Caribbean every year that they write off on the business and spend money on different items, then there's a lot of due diligence there and conversation around, hey, what's truly a business expense and what's truly a personal expense. That's something that does require a lot of due diligence, because that can change a business that's showing 5% net profit on the tax return. That business might be doing 20% net profit after you determine the true cash flow that the business generates. We call those add backs. And that's something that we do a lot of verification on and underwriting too. One item that, I always find funny that unfortunately we can never add back is cash jobs. Business owners doing $30,000 or $50,000 of cash jobs each year. Fortunately, that's one that's non-negotiable for us. And typical add backs for us, I would say, the guy selling a business or a woman selling a business, that for the salary that they paid themselves as the owner, there's a interest expense. That's a non-cash expense on the tax return that we add back. Same with depreciation, amortization. If they run their vehicle expense through the business or health insurance, those are pretty common items for us.
And in general, just a big complicator from a valuation standpoint, because you have to basically go and pull all that stuff out, and it just complicates everything, right?
We always encourage folks to have clean books and report everything as they should. That really help the process on our end when it comes time to either finance the business they want to sell or finance the business they want to buy.
If you're out there advising someone, like you said, there's a few active deals every week. What's your recommendation, number one recommendation to someone that comes to you and is looking to buy a small HVAC company?
Great question. First and foremost, we want the folks that are coming to us to do their own due diligence on the business. We want them to kind of take a look under the hood and tell us what things they like about the business, what things they don't like about the business. Believe it or not, I've had phone calls, certain folks, and I'll say, why do you want to buy this business? And typically we'll see this with non-industry buyers. So they'll say, well, the HVAC industry is recession proof and this business makes a lot of money. When we get that answer, it can be a little unsettling. We really like to see our folks put in a lot of thought. Outside of doing their own due diligence, just making sure that it's a good fit for them. Does it make sense for a guy that's historically ran a $500,000 top line revenue company to go buy a $20 million top line revenue company? Probably not. Want to make sure that the transition plan makes sense, that you feel confident about it. And then also, we like to see our customers maintain a responsible personal financial lifestyle. So just making sure they're being aware of their personal credit and, not going out and buying yachts and Ferraris. Can't manage their personal finances responsibly, then they're probably not going to be able to manage business finances responsibly. So we tend to see those two go hand in hand.
Are you active in social media? Where's your playing ground?
Yeah, mostly LinkedIn. You can search my name, Dillon Caraway, on LinkedIn, Live Oak Bank, and love to connect. We share a lot of cool case studies on LinkedIn, new products that we're coming out with, different active deals that we're working on, obviously maintaining confidentiality for our customers. But yeah, LinkedIn would be a great place to connect. That's actually where our paths cross. Yeah, definitely connect with me on LinkedIn.
Actually, I had this in my show notes that I wanted to ask. When you're in the heart of a lending and a deal, who are you primarily working with? Let's just say there's obviously a buyer and a seller, right? And let's say more complicated, there's people representing the buyer and the seller. Who are you working with at that point in time when there's a lot of people involved in the deal?
Great question. Typically, our main point of contact is going to be that business owner. That's going to be our customer on the loan.
Okay.
But we also work with a lot of CFO or general manager or an office manager. We have, written permission to work with them. We communicate that way. Also work with a lot of brokers if they're representing the deal. And then, especially in the closing side, we work with buyer and sellers, legal counsel as well. We touch a lot of different parts of the process, essentially involved in every step from, first phone call to funds going out the door. After that, helping customers with additional needs after the loan has been closed. But I would say 9 times out of 10, our primary point of contact is going to be that business owner.
I think that's super important. Just add your expertise and keep things moving along. Like you said, time kills all deals. You don't want there to be much friction. The reduction of friction will help just things move more quickly and move more swiftly. Well, cool, man. Well, thank you again. Appreciate having you.
Zach, thank you again, man.
Thank you, everyone, for joining us on another episode of The Boost. Please move forward judiciously and go get them.